Hello, everyone, and welcome to the Trust Blueprint. Today, we're diving into the future of financial services with a true industry leader. My guest today is Ian Macallister. And if you've listened to some of our past episodes where we talked about Visa and how product, policy, technology, and politics came together to solve trust across a network, I'm really excited today because we've got a true industry leader who solved these problems and other businesses. So Ian has recently joined Proof as EVP of Strategy and Business Development, but earlier in career, he's got decades of experience at companies like Plaid, Unit21, Early Warning, which is Zelle, and he's gone toe to toe negotiating deals with the likes of the big banks, Apple, you name it. He's an expert when it comes to understanding how banks and fintechs come together to bridge gaps in identity, risk, and payment infrastructure. And I'm excited to talk to him today. Join us as we go deep into Ian's career, what it was like working at Zelle, the impact mobile wallets have had on banking, and the ongoing debate around open banking. Welcome, Ian. I'm excited to have you today.
Thanks, Matt. Thanks for having me. I'm also waiting for the texts from all the prior Zelle executives saying it wasn't just you, man.
All right, Ian. Let's jump right into it. Hopefully, your former early warning colleagues don't come after you with a stick. But so you've been at the center of some of the most significant changes in payments and fintech, and you name it, over the last really decade. And looking back across that time, there's been a lot of hard fought battles, a lot of successes. A lot of people feel like we're going backwards right now with some of the initiatives around open banking. But what do you see as some of the biggest challenges getting these legacy industries to adopt technology and to move forward?
Yeah. Well, first of all, thanks again for having me. It's there's a bit of luck when your career evolves the way mine has. I was banker half my career, and the last 10 years plus, I've been in payments, risk, and worked with some of these amazing companies. Um, It's funny, just a quick story. Like in 2006, Wells Fargo was rolling out like an operational risk infrastructure of which I was part of. And at the time I thought it was not that interesting and it was like fraud and risk management and capital requirements, stuff like that. But it's like the basis of everything banks do and how fintechs need to think about working with banks. So a lot of that stuff that I thought was boring is actually like the key to be able to go have conversations with some of these entities. Um, and I think that's just it's helped the evolution of the career. But we just had a board meeting and we talked about this a little bit, like the evolution of fintech and working with some of these entities. And I'll just like replay some of the things that we talked about, like because like 2008 Visa, because you talked about Visa earlier. Um, they were forced to go public because they were bank owned before, and the Department of Justice said, listen, we need to open up people's access to Visa. And by going public, it allowed them to think about their business model differently, where they could work with different entities, not just the banks, and how could they enable, you know, better value for their shareholders. And so if you just look at the genesis of a lot of the fintech evolution that's happened over the last 16, 17 years, right after that, it triggered a lot of these payment companies to be founded. So you have like Square at the time was founded in like 2008, I believe, like right afterwards. You have Venmo right after that. PayPal had been in existence for a while, but like PayPal bought Venmo. And the adoption of those services, those fintechs was pretty amazing. Like the consumer adoption, a lot of younger people were going more natively digital, and the banks, saw that happening for the last 4 years. If you fast forward to 2012, and in 2012, I think, they had seen it. They're smart. They had seen this kind of writing, but it finally triggered them to, similar to how they built out Visa as like a consortium of banks. And we'll get into early warning a little bit, but they got together, top three banks, Wells, B of A, and Chase, said like we need to create a network for ourselves. So consumers, especially younger consumers, aren't going to third party apps. They're going to us. And we are the ones that are going to create this experience just that they can send money to anyone in the US. And so there's been a lot of articles and a lot of podcasts around like Zelle, but the base of it was the banks were trying to secure their relationship with consumers. And that's like a theme that has happened time and time again. And we can talk about like Apple launching Apple Pay. You can talk about Apple Cash later. You can talk about Apple's buy now pay later. So like Apple's a theme there, but like the banks, when they collaborate very well when they think about how they can make an industry standard. You have Visa, early warnings of standard for bank fraud, fighting fraud for bank consortiums. Zelle is the bank standard for P2P. So that's like a long-winded way of like, why do banks actually care? I mean, that's one reason. It's not all the reasons, but it's definitely one reason. It's the relationship with the consumer, and these third-party apps were getting a lot of momentum. Now, you think about what they were also providing. They were providing a lot of like upstage technology. So like Square and Venmo, they had like it was all based on new technology. It was based on a really good user experience. It was based on real time kind of transfers once you actually funded your wallet, and it created this social aspect of how you send money to each other. And if you think about the banks before 2010, like they didn't really have any of that. So they realized we need to build a real time network based on sending people money directly to and from your own account versus having to open up a third party wallet, and creating a uniform user experience around that. So, although it was called something different before Zelle, it's called Clear Exchange, and all the banks could name it whatever they wanted to. They finally aligned around, listen, we need a real time network. I mean, the legacy or the Clear Exchange need to have real time risk infrastructure. We need a common user experience. So when people open up their apps, they can point at it and say, this is how you send money or receive. And you need a common brand. So it shows like a uniformity of how the banks are thinking of working together. And so like it took a while to get there for sure. And it started with the top three banks because they created a network. If you're building a network, you want size. There's like an S curve, and the top three banks represent like over 40% of the US. So like it gets you to mass. And then, the fun ride, and it wasn't just me, it was a lot of hardworking people inside of early warning, because early warning became the entity that owned Zelle, top down from the CEO down. Everyone was uniformly aligned to build this amazing product. But also we lined up really key partners, and those partners included like large technology companies like Jack Henry, Pfizer, FIS, even the card networks, who were really skeptical of what we were building because we looked like a complete threat to them, with the banks. But we needed a partner with Visa and MasterCard because they had ubiquity. When I say 40% of the banks, or those banks represent 40% of the US, there's still 60% that you have to get to in real time with risk infrastructure. And although we wanted to bring every bank into the network, it wasn't, that's not feasible. It's still not feasible. They don't have every bank in the US and credit union in the US. So you have to use other partners that may think that you're a threat, but if you do it away, you can thread that needle away that like empowers their business to launch better products, and then also helps you get to, a uniform ubiquitous experience.
Yeah, so maybe to talk about then just where we are right now, right? So, again, so it took Visa decades, and the world we live in today, someone can take their Visa, their MasterCard, whatever it may be, and they can transact globally. It's accepted. And so now Zelle really has accomplished the same, right? Like you can message kind of anyone in the world and send them money, right? And what sort of challenges remain for that network? It's achieved scale, but there's been a lot in the news lately about, the cons of what have been created and how it's playing out. So maybe if you could talk a little bit about like what remains unsolved in that Zelle paradigm that maybe Visa has solved for in theirs.
Yeah, I think well, they're definitely different use cases, right? Like let's just start there. Visa is a commerce type of transaction, and Zelle is although they do have some smaller commerce, it is a social P2P type of network. And what Visa has solved is, and there's things that they haven't solved too, so we can dig into that. But like what they've solved is like they've figured out where the right value exchange is between the Walmarts of the world, where somebody's going and buying something, and the bank that person buying has a credit card associated with. And so like there's a clear value exchange between like who's who's reimbursing each other fees, who is taking the risk and the liability infrastructure, who's like, and what type of data is shared back and forth to reduce the amount of fraud. And Visa sits in the middle, and they've done a really nice job to create these commercial incentives such that that whole network works really, really well. Now, not too dissimilar from that, Zelle actually has done the same. They have a lot of governance around like what type of use cases you can have, who bears the fraud liability when it happens, what's their responsibility when somebody tries to dispute but at the heart of it, like there is a whole revenue aspect to these like Visa's business model for the banks and the merchants that, Zelle right now is it's a social, it's a way for banks to maintain a relationship with their consumers, especially if they're more digital native. So like the value prop is just different. And so focusing on those use cases that Zelle can like proliferate in like creating affinity to the bank's digital app is critical, but also like not disintermediating a lot of the revenue that the banks are used to with these.
Yeah, but I mean, Zelle, bunch of news just last week with the Attorney General of New York coming out. And, I think some of the scam problem, I'm curious
Yeah.
if you could help people understand some of what's going on there.
Yeah. Sure. So look, scams happen. And so not to get too technical, but if you think about a Zelle transaction, which is like I'm sending you money, I'm making the decision and I'm pushing it to you versus like historically a lot of the transactions are like I'm pulling it from you. So like my point is that like scams are I would say a little bit of clickbait. Like the vault, I don't know the numbers, but I'm fairly certain that the amount of scams that happen over Zelle from a percentage standpoint are comparatively low to like just the amount of first party fraud that happens on like a merchant transaction. So like let's just say it's like the volume's low, but the impact is really high. Like my grandmother getting scammed is like really hurtful to me and my family. So it's like, of course I'm gonna get pretty ticked off about that. So in a Zelle transaction, like especially with deepfakes or somebody being able to like, scam my mother-in-law or my father and saying, hey, send me money. I'm pushing it to you. And then it's like, God, it's like I'm handing you cash and then I'm like leaving. And so that whole process is like fraught with like concern that people are really exposed to like irrevocable like sending money out, like somebody just took your money. So I understand like the social concern around it. What I would say is that, look, I mean, politicians are politicians. They're gonna highlight things that they think are gonna get them votes, and I'm not looking to get in the crossfire. But the reality is that like banks don't want their consumers to get scammed. Zelle doesn't like fraud is bad for any network. It's bad. That's why I talked about Visa. Like they focus on fraud. Zelle focuses on scams. Zelle was merged with Early Warning because Early Warning is a fraud consortium, and so the amount of time and effort that they put into reducing kind of fraud across the network is I would say probably tops versus really others. Now, are they the right target? Probably because they probably have the means to be able to do something about it. And like if by doing something about it means like identifying when people are bad actors on the other side, shutting that down, putting technology in place where like you have to identify and verify somebody's identity as like a recipient from your grandmother. Like those are all good things to ensure that are in place.
Yeah, and if I could maybe interject on that, I think what's interesting is that I think when people are transacting in Visa, MasterCard, American Express, whatever it may be, you are transacting with a verified merchant, right? It's Walmart, it's the bodega down the street, whatever it may be. And the merchant has a set of obligations that they have to meet to be a part of the network. First off, they're verified. To be on the Visa network or whatever it may be, you have to prove who you are as a merchant. And they also then track your behavior, right? And they know over time, if consumers are reporting that you're not delivering goods, for example, you might get booted, or there might be other penalties, or you have to pay higher rates associated with fraud. And in Zelle, by its very nature, being consumer to consumer, it's a consumer identity problem, right? And so, maybe that takes me for where to go next, which is, that organization did attempt to bring identity to market, right? And ultimately, we all, everyone probably listening has used Zelle. They have it as part of their banking application. They don't have a bank identity, right? And so why did they attempt it? Why did it ultimately not have the success that they wanted? I think is a useful topic to get into.
Yeah, just to put a little history on that. So like early warning and the banks, they were trying to create like a digital, or like this has happened in Europe. There's like a thing called bank ID where like you can use a persistent ID to go bank to bank, and you can like where you don't have to go through a whole litany of KYC checks to go to another bank. And the US, we were trying to do the same, right? And it's like that there's a fundamental difference in the US than in Europe. So there's like a comparatively, there's a few banks in Europe, and there's like 10,000 banks and credit unions in the US. And there's a range of how much one bank will of cost they'll put into like KYCing somebody versus another. And like, can they fundamentally trust each other? Because they both have the obligation to run a consumer through onboarding KYC process. But like very, very large bank has a lot of dollars associated with KYCing somebody, and somebody who in a very maybe small credit union or local bank relies on in-person, in branch verification. And like those two risk profiles are just dramatically different. So can they, when you're trying to build like this persistent identity where you can bring it from bank to bank, and all the banks have to trust that the other bank or credit union did something to their level of controls, it kind of breaks down when you have a different risk tolerance of how you KYC somebody. So that's like generally what has happened in the US is, you know, can I trust this other regulated bank that they did everything that I would have done? I mean, I think the answer is generally you trust that, but maybe not, that very one or two branch bank. And that's fundamentally how it dissolve. So I do think that there are, proof being one of them, why I joined is like, I think that there's technology that we have in our platform that is highly regulated, is part of people's like most important transactions in their lives, and people trust it to do these large, $1 million transactions. Well, if banks and trust companies and payment companies can trust us to do that, then why isn't that technology like top notch for the rest of the day?
Yeah, you also, but you mentioned KYC AML in that, right? So you said, they have these huge investments in KYC AML. So I presume people listening understand, but so this is regulations related to opening a new account and ensuring that the person isn't terrorist, money laundering, things of that nature. So how do we sort of protect the system as a whole, right? And so if I was going to play back what you said, it's that, maybe banks don't trust that everyone else did a good job with that, right? But look, our definition of identity is even more expansive. Like what you're talking about is account opening, whether you're going to give someone a new account. And what we're talking about is securing every transaction. And if you go back and some of the discussion around Visa was ultimately there's a liability shift, and they take on fraud and risk. And it's not just them, but the whole ecosystem has policies and whatnot to take on the fraud and risk in these transactions. And there's just fundamentally not an incentive. Like if I'm a bank and I've proven who my client is, and that client is now transacting elsewhere, do I have an incentive to stand behind it in the same way that I stand behind someone's credit worthiness in a credit card transaction? Like that's fundamentally what they're doing. They're saying, yes, Ian can buy the $1,000 TV because historically he's been good for it, right? I just think there's not the incentive for them to do it. So in my mind, that the other aspect of it is like there's a disincentive. Like, and I think this brings us maybe into your Plaid era, right? Which is if the only benefit of a persistent identity is account opening, and if banks are being asked to stand behind their customers, what they're really being asked is to take all of their investment in proving who someone is and making it easier for their competitors to steal their clients, right? And so maybe that's a good segue into like what then ultimately got you from early warning and Zelle over to Plaid, and how is that sort of a continuation of the same story?
Yeah. Yeah, you probably say it right. Banks spent a lot of money to acquire a consumer, and then why would they share that secret sauce with somebody else so they can go somewhere else faster? I think that is, probably you know, the dark side of that. But look, I'll just, before I get into Plaid, what I say is, I think you're talking about liability and governance and like all the things banks really care about. And what I've seen historically is when technology companies don't have that basis of which they're trying to engage these entities, they're just like a new tech. They're trying to solve user experience. They try to solve like something very fast and cheap and all that kind of stuff. And like, yeah, you need to do all that, but you also have to realize that there's like a real business model around liability shift, fees within the Visa network, blah, blah. So Plaid. So look, Plaid's been an amazing infrastructure player that has absolutely accelerated fintech growth over the last 10, 12 years. It accelerated during COVID for sure. And they've been an infrastructure player for a long time. And I knew about them at early warning. All the banks knew about them. And early days, they had a very combative relationship, and some may still, but like, yeah, I'm not going to comment too much. I mean, well, but like on the Chase news with the aggregators. But I would say Plaid itself was going through an evolution in 2021 where their technology, they had a couple things. One is like their technology was shifting from a thing called screen scraping, where they're using your password and username and password, and looking at your banking data and pulling it down to, and that did not have the bank included. Like the bank was like outside of that user experience, without experience, to using bank sanctioned APIs. And these APIs are more structured, hopefully higher quality, just all in real time to enable like a Plaid to get access to your Bank of America data through a more secure consumer consented way versus them acting on your behalf and scraping your data. So like, and that was really critical to banks to move towards that, because a couple of different reasons, but I mean, on the more structural one, like they didn't want somebody to pretend they're somebody else and then download the data. So they didn't want Plaid to look like Ian, scrape the data. They would rather know that Plaid was acting on Ian's behalf in a secure PPI manner. And so there's been this move for the industry to build these APIs as a bank or a credit union or a technology provider, and the aggregators to use those when they exist. And so like that, but that's also comes along with liability, SLAs, all this stuff that's in a 60 to 80 page agreement. And so Plaid was hiring really capable people in policy and product and like all these spaces that had negotiated these like more complex relationships with banks in the past. And so I found myself, wanted to not work for a bank or a bank consortium anymore. And I was like, I wouldn't mind working for a fintech and understanding the side. And I learned a lot there, especially from a product and technology build, like great, amazing teams, how they built and deployed products, but also helping them understand that the sophistication of working some of these banks is like rooted in governance and rooted in liability and rooted in these things and structure. Now, and so the whole job was like how to revert the like adversarial relationship with these banks to being like friendly around like enabling consumers to share their data. And then two is, Plaid wants to get into payments. They need banks to get into payments. So you need somebody who knows how to talk to banks there. Plaid wants to sell into, banks. So it's like, how do you sell into banks? And so I ran revenue at early warning. So it's like trying to help them do that. And it was really interesting because it was similar to when the banks were trying to figure out how to become more of a fintech. Fintech was kind of trying to figure out how to become more of like a bank. And so like when I launching Zelle, this bank's becoming a fintech, and I'm not going to call Plaid a bank. I think I would get a lot of nasty emails because they're not. They're like an innovator, but they're an infrastructure player. But they have to work with those entities.
Well, and they've enabled an enormous amount of innovation, right?
Yeah.
You hit on that, but I mean, for the last 10 years, it's sort of been a golden era of innovation and crypto and all sorts of things, which is, for us, I think a very interesting time because, I think that my opinion, I presume people understand, but, JP Morgan has recently come out and said that Plaid has to pay for access to the data, right? And, a lot of people are up in arms saying, well, that's going to stifle innovation. And is this the customer's data or is it the bank's data and whatnot? But, in my mind, I think we're kind of in a situation where actually perhaps both sides are right. And there's actually some pretty principled positions on both sides, and it's a solvable, dynamic. But on the innovation side, I think what's really critical is that, I see a similar dynamic playing out in crypto, right? And the Genius Act recently passed. And as part of that, there has to be a regime for, KYC AML. It's the same issue coming back around. And suddenly it's like, okay, crypto, you've got to seat at the big boys table. And stable coins, all these banks are saying, yes, we now want to adopt and whatnot, but people suddenly have to meet the rules. And so I'm curious, if you have a perspective on how that industry can move forward and maybe reach sort of a better agreement at the outset. So unlike open banking, there isn't this sort of comeuppance ten years later.
Yeah, it's funny because I'm probably going to date this podcast the second we talk about it, but like the Illinois, like they just passed this state law against the crypto bros, and it's like this big backswing around like you need to be governed a little bit more. So it's like the end of it. But look, I think well maybe so as the innovations happened, start with banking as a service. So if anybody's familiar with banking services, effectively these banks, quote unquote, lend their banking charter to fintechs to operate more like to do payments or to do lending or card issuance, that kind of stuff. And so banking as a service, there's a lot of entities out there that have built a really good business model. Some have not built a very good business model because they don't have good controls, and I won't talk about those, but you can read about them. But they've built a good business model where their clients are fintechs, and fintechs are like, I need to borrow your license so I can do payments, get access to ACH, get access to wires. The business model 5, 6 years ago was the bank said, okay, contractually, here are all the things that you need to do. And you need like a BSA officer, you need to do AML, you need to do KYC, you need to do all these things. So you start looking like what we would do for end consumers, such that when the regulator is like, hey, you have these payments going through you because you have a client that's a fintech, do you have any controls on them on how they like make sure that they're not doing terrorist financing? And they say, yes, I have this contract. I have this contract that they're going to do it. Okay, do you audit them? And like, yes, we talk to them once a year. And then, but that model, that trust model actually has broken down a bit over the last couple of years in banking the service because of some of those bad actors or those bad business models. And it's become a lot more like rigorous. Like the banks themselves actually need to pierce that wall with fintech. So I think we're like, if you think of that as the trajectory of crypto and stablecoin, like what has happened. So the Genius Act legitimizes a lot of different things, but it also puts in place like really hardens the requirement around when somebody is sending value over crypto, they not only need to know they're KYCing the person on one side, they need to know that they need to know the recipient on the other side. And there's some structure around that, but like that requirement is like the next level of like governance into over stablecoin. Now, my observation is, and we've talked about this a little bit, is it just came out. There's a lot of business models in stablecoin in crypto today that they all say they solve it, similar to like banking as a service early days where they say, I have a contract with somebody and I kind of audit them. I think people are solving it in a way that is going to evolve. It's going to get more rigorous. But there's this battle now, and you can see, I mentioned the Illinois thing because there's a battle between the crypto companies that want to innovate and move fast and break stuff and go, understanding they have a compliance obligation. But then there's a policy angle that some more sophisticated, I would say, entities in the crypto space are really thinking about. We need to influence policy so we can at least skate to a place where we can be innovative, but we can we can control what the policy looks like around what type of KYC AML process you have. So I think that there's a gap between actual how the business is set up today generally and where it needs to go. And that's just an evolution of anything, but that's, you know.
It's interesting, I just see such a corollary between all these different conversations. I mean, what you just described is, we talked about Zelle and we said, why wasn't Zelle successful entering identity? And what we said is that they decided that they didn't know if they could trust each other's programs, right? So one bank is really good at validating their customer's identity. Another bank might not be. And ultimately, given all of the liability in banking, are they willing to sort of outsource and trust someone else for having done the work? The answer was no. So that remained an unsolved problem. We talked about Visa and said Visa is a network where they have very strong confidence in both sides of the transaction. They've got confidence in the consumer, they've got confidence in the business. And then we talked about P2B payments in Zelle, where the scams issue is that you're sending a transaction to someone who you don't know who they are on the other side of the transaction. They're all fundamentally the same problem, right? In order to have a secure transaction network, you have to know who both sides of the transaction are, and that's what I'm so excited is I'm really seeing a convergence in how to solve the problem. And of course I'm selling our own book here, but it's just interesting how the same problem repeats itself, over and over again. And I think a company we haven't talked enough about in this is Apple, right? And you alluded to them early on as being a catalyst, right? You said that Apple Cash and whatnot really drove some of the Square and that whole world of innovation, but I don't know that people recognize that they're actually now taking balance sheet risk, they're lending. And a lot of people believe that it is, Apple and or Google because of the sort of hardware distribution that they have with phones that might own the next era of identity, mobile driver's license programs, right? And if you put yourself back in a banker's seat and you are, a large retail bank, what does that threat represent? Them now taking balance sheet risks and them now owning identity.
Yeah. So if they're taking balance sheet risk, are they governed the way banks are? So do they still have the same, like, it's just like one, like, is that a fair playing field? Like, do they have the same regulatory oversight? Do they have the same capital requirements? When they grow too fast, are they actually challenged? Like those things actually happen in banks. And so if you're taking on more of the bank type of value chain, but without the cost. And I think it's a little bit of what Chase was doing with Plaid, not to go backwards in this conversation, but like you can't have a business model with just revenue and no cost. And so like, don't get me wrong, Apple has a lot of costs, but they also like there's aspects of what they do, which, kind of lean into, well, that's a very regulated entity space. And there's a governance cost, there's a capital cost, all those things. So is that fair? So that's like one bank comment. But two, I'll go back to the same thing with why they launched Zelle. It's like, who owns the identity of the consumer, right? Like, why did I pay $500 or $1,000 for this consumer to be able to acquire them, give them all access to all these services, but they're treating, but Apple didn't pay them. Maybe they paid some vendor costs to KYC somebody, but they got $1,000 for a phone, right? Like Apple actually got money because somebody bought a phone. So it's like, is that it's an interesting kind of switch where it's like, the consumer's actually paying you to KYC themselves almost, but it does fundamentally go back to like, how do you maintain that consumer relationship? Because the consumer is very unprofitable when they're 20 years old. They're they can be very profitable when they're older. And so like, you want to capture them early and make sure that they know that the bank and like you have the right digital experiences for them. And that's why the banks have, also launched other products like Pays which is their card kind of scheme to be the a potential Apple Pay competitor. And they also have Akoya, which they are part of, which is part of open banking infrastructure play, to be the brand there. So, they invest in areas where they're constantly trying to say, listen, it's the bank brand to present it to you when you're trying to use digital experiences. So that's my bank response is like, how do you continue to maintain parity against in a industry that's extremely innovative and fast and all that kind of stuff. So I think that's the challenge for banks for sure.
Yeah, it's interesting, I've been doing this a long time now. I'm approaching graybeard status, but in the 10 plus years I've been doing this, I think mortgage lending is a really interesting, leading indicator, right? And I say that because, if you look at charts over the history of time, mortgage lending used to be predominantly bank, right? And now it is predominantly non-bank, which non-bank mortgage lending means fintech, right? And now these are big fintechs, but Quicken Loans is absolutely, now Rocket is absolutely an example of a very successful now at scale fintech guaranteed rate. United Wholesale Mortgage is the country's largest mortgage lender now, right? And the regulatory burdens placed on banks related to mortgage lending really inverted the economics such that it became less appealing. And these banks said, they kind of were fine ceding the market to these non-bank lenders. And many very prominent bank CEOs are kind of out saying, we're fine with this, transition of mortgage lending into the non-bank fintech market. I actually personally had a belief 10 years ago that would either slow or reverse, because if you believe in the future of technology and push button get mortgage, right? That I walk in a house, I want to buy it, and I want a mortgage right now. Who is positioned to do that? It's a bank, because they have a long running relationship with you. They understand your credit worthiness and your income and your assets, and they're best positioned to just like give you that mortgage. And either from a lack of execution or the fact that they've just kind of fine with the market shifting, it's gone to non-bank. And I think that is the concern they have in their retail business, right? That these fintechs, ultimately the market shifts and more deposits end up in these fintech businesses. And I just think identity is such a critical part of how they see playing it out.
Yeah. I mean, it's played out a little bit further. It's like, okay, so if the banks are willing to cede some of that business, but they still need line of sight to what the consumers are doing so they can present them with the right services, like they need a tie, right? They need a tie into Rocket where somebody, this is Plaid's angle too, right? Like, it's like, how do you share not only bank data to Rocket, but Rocket data back to banks? Like that's it. And it's all rooted on consumer owning their data, Dodd-Frank 1033, all this kind of stuff. But, and banks should embrace it. The banks that have embraced that, I think, are the ones who are thinking about, okay, how do maybe I don't own that asset, but I own the insight. I can build insights around that where that consumer has financial transactions. So I can actually provide them a more sophisticated wealth management solution or something, right? Because these fintechs, like you mentioned, they're still trying to all become the super apps. They are, but who's really the super app of it? I mean, we talked about apps a little bit, but like, is there really a super app here in any of these scenarios? It's super fragmented. So they don't like, one could argue that the banks or the financial institutions and the ones that have the right to win that super app, they just have a different cost infrastructure. They have a different technology infrastructure. It goes back to Zelle. Like they need to rely on third parties to do a persistent identity or a real-time transaction or because their technology. And that's actually what you're seeing. Sorry, now I'm bouncing around a little bit, but that's what you're seeing a little bit with crypto is the bank core is not ready for like crypto transaction or stablecoin. So you have like all these businesses spinning up where they're like, I'm going to be a side core to you and enable you. It's like, yeah, because the banks actually want to play a stablecoin. They want technology to work fast. They just have $1 trillion banking core that they can't just rip and replace while a fintech can. So like one, you can shake your fist at fintechs, but you're also the banks that are going to win are the ones that figure out how to work this.
Well, yeah, look, my personal bias is actually that the bar should be really high, right? And I think about, we talk about SVB and First Republic and whatnot and sort of the flight to quality, but at the end of the day, my perspective is that mortgage lending should be hard and that, holding trillions of dollars of assets for consumers, it should be hard. It should come with a huge burden and obligation of that responsibility. And I also feel that it's getting harder, right? And I think that, Sam Altman came out recently and he said, that banks shouldn't be relying on voice authentication anymore. And there's a huge fraud and security risk associated with this. And who's going to be most capable of, who do I want my money with, right? And it's an institution that has the resources to be on the cutting edge of these problems and procure the best technology and has the expertise to solve these problems. So it's a really interesting time, right? Where there's all this innovation from a consumer experience standpoint, all this threat of fraud and risk, right? And again, I just think that identity is a really, really critical part of it. So, maybe to wrap this up, I mean, so why did you come here, right? And what are your thoughts on the path forward?
Yeah. Unfinished business.
I love that, actually. I love people with unfinished business. I have it too.
The evolution of what proof has been over the last 10 years and thinking about identity as a way to secure everything, payments, contracts, mortgages, whatever, is I fully believe that. I mean, even thinking about agentic commerce, where you're like enabling an agent, an AI agent to go do something for you and spend your money. The Visa and MasterCard figure out a way to create a token associated with those agents, but like is that really tied to your identity? So like if you have this like digital persistent identity that's tied to something real, your physical self, like your biometrics, then it makes it safer for the consumer because you're not proliferating agents like randomly. You're actually consenting to use like your identity tied to that agent. The merchants were really happy about it because they're like, I'm going to ignore all these crazy rogue agents that don't actually have a like a real physical identity, a person where I can see them on video, that kind of stuff. So they audit trail back to a consumer consenting, right? Like that's really powerful. And then like for the banks, they're like, you know, if they can enable a digital identity for one of their consumers and then they can help them do other types of commerce, like that's innovation for banks. Like that's pretty cool. And it's like if anybody who's full like looks at my LinkedIn page, they're like, okay, you did a lot of partner stuff, did a lot of things with like you're taking organizations that historically have been at odds and figure out a way to thread the needle where they're partnering together and make it a better ecosystem. And that's why I joined. And that's some of the things, I was able to do a little bit in fraud, open banking, Zelle, identity's the final frontier, man.
I agree. And I also just think, why now? I mean, it's because of what's happening with AI and what Sam came out and said. I mean, it's people are being forced right now to consider these issues. And so it's really exciting. I'm really happy to, to be working with you and have the experience and the network. I mean, there's definitely, it's not just you. I mean, I joke about unfinished business, but it seems like a lot of folks, from some of the places you work have this sense of unfinished business. And, I'm really excited to go get this thing done. So I hope for everyone listening, this was an awesome episode. That's all we've got time for today. So I want to thank Ian for joining today and being on the first episode of the Trust Blueprint. You can find us on Apple and Spotify, along with a full video version on YouTube. And this is the first of many. Fraud, identity, risk, trust. It's being completely rewritten in every industry and every sector. So we're thrilled to have a long list of fantastic people join us. So enjoy the day, everyone. Take care.
Thanks, Matt.